And overall, the market's up, what, 150% in 15 years? So I think $2 trillion a day was the reported volumes back in 98. And then 2013, you were up near $5 trillion. So it's still a huge market. I mean, the last 12 months, 18 months, I see as the natural ebb and flow within any market. So there's huge opportunity. I think there was an IT group study recently that's predicted 30% uptick in volumes by 2016. I think that could even be lowballed. There's plenty of new players coming into the market. You're seeing growth both geographically from the Asia Pacific area and people coming in from other asset classes such as fixed income, equities, looking at this highly liquid asset class. So for us, it's just a land of opportunity. And I think it's just a natural ebb and flow of the markets right now. I kind of go back to it. The size of the market deserves probably more participants than you saw back in 2008 and 9. It's very unusual that you have a duopoly, for example, or a market of that size owned by 3 or 4 significant players. And going back to David's point, yes, the barrier to entry is now lower. You can harness modern technology. You can offer it to a wider range of market participants. So in LMAX Exchange, for example, we allow the same access to institutional liquidity whether you want to trade in a clip of $10,000 or 10 million or 20 million. So it's opening that up, and it's being able to bring something new to the marketplace. So what's interesting for us is trying to bring in the exchange quality of execution that you see in other asset classes to FX. So certainly I think in 2008-9 there was huge opportunity, and I think the same applies now. And there is room for plenty more participants. Choice is a good thing. Competition is a good thing. It drives their overall cost of trading down for the buy-side customer. Ultimately for the sell side, for liquidity providers, they are looking for people that can bring them extra flow. They realize now they won't own the end customer all themselves. So if you can bring differentiated flow to them, that's a good thing for the marketplace. And overall, I think the market becomes more transparent with better pricing and obviously on LMAX with a greater consistency of execution. The question in 2 parts. The first bit, rules, we agree. We were the first regulated MTF for FX. That means you must have a published rule book. You can access it online. That means all the members, all the general members, all the liquidity providers have the same ability to access, the same ability to access market data, the same rates of order update. So it's published, and likewise on the broker side, it's the same thing. So I think rules are a good thing in the marketplace. In terms of, I guess you're alluding to latency floors, speed bumps, and then randomization, I think it's too early for both. I think it's a extra level of complexity in what's already a relatively complex marketplace. Those platforms that have introduced it already haven't introduced it across the board on all currency pairs. Why is that? Are we sure 1, 2, 3 milliseconds, or one of the new players is talking about 50 or 70 milliseconds? Why is that the right number? I'd agree that you don't want to get into nanoseconds. You don't want to get into this high-cost equity exchange that you've seen out in Basildon, where you're measuring length of cable down to millimeters. I agree you don't need to get there, but I think we've got a long way to go on FX. So on LMAX, a mix of banks and non-banks cancel and replace in under a millisecond. They can do that typically within 200, 300 microseconds. We don't see any advantage to banks or non-banks. So I think it's too early, certainly for latency floors, but it's a trivial technological advancement, if you want to call it an advancement. I think randomization, if I'm honest with you, is kind of crazy. I've never yet met anyone that says, yeah, put my order in the book and just, fill me randomly. I just can't see the point in that. First thing you must do is a manual thing, which is you've got to police your customer base on the buy side. Every platform has that duty to its market makers, to its liquidity providers. So number one, if you come on and say I'm a news trader, well, there's not much value to me as a platform provider on that, and there's certainly no value to the underlying liquidity provider on that. Likewise, if your intention is to have cross-platform arbitrage or latency arbitrage, there's no value. So why trade on LMAX? So first of all, you've got to do that. Make sure you deliver the right flow to the liquidity providers. I think then in terms of high-frequency trading, what is high-frequency trading? That's what we need to get down to. It's the big bad wolf, apparently, in the FX market. Sometimes I think it's just algorithmic execution. So some of the best high-frequency traders sit in banks, right now. So there's no difference to me. I mean, we have, as I said before, everyone has the same throttle rate. So all our liquidity providers can price 2,000 orders a second in fast markets. Our job at LMAX Exchange is to try and make our message rate up to 100,000 orders per second in 2014. We're currently up to around 20,000 orders per second, and I expect to send that significantly higher. So again, it's the same access to all. I can see on certain venues that they might want it, but I think that problem is deficiencies in the venues and the technology. You must remember, I also have an LMAX interbank platform. So LMAX Professional, that services funds, brokers, and money managers. Interbank, which is a bank-only platform, and institutional, which is high-frequency fund exchange. So, as I said, in all of those venues, no one has yet asked for randomization. The bank-only pool, who are the same guys, agreeing to randomization, have not asked for it. We could implement it, but again, you go and speak to some of the banks. When they have interest, when they want to get done, they don't want to be randomized. They want to hit the price as quickly as possible. Yeah. And I can't see why if the technology offers everyone the ability to update and price precisely, why they'd want to be randomized if they have interest. So last look is what they would call a business solution to a technology problem historically. It gave control to the liquidity providers, the ability to reject or requote whenever an order comes in. It's the only asset class where that happens. And I don't think you any longer need that business solution to a technology problem because technology is caught up. Back down to why speed matters, why message rate matters. You allow a market maker to price accurately at all times, to cancel and replace in less than 1 millisecond. That means there's less chance of him having a stale order in the order book. That means the buy side gets a better quality and consistency of execution. And back to it, that's the value that new venues can bring to the buy side. Ultimately, it's about cost of trading to them. The cost of trading goes up enormously if you're getting rejected, requoted in 200 milliseconds, 300 milliseconds in a fast market. In a high frequency driven market, and that is what's happening in FX, those periods of rejection and requote or holding periods are forever and it costs you money. So quite simply, we've got a published rule book. We offer exchange quality of execution. We will never have last look. The same price providers who price into all the other venues, the venues to my right, do so on LMAX without last look, without the ability to reject or requote an order. Quite simply, like every other asset class, we have an open order book with streamed limit orders, not just prices that can be rejected. There's no point in showing a tight price that you can't hit, and that doesn't happen on LMAX.